Okay, so let me just put the diagram that we'll be using, which we'll be referring to for our journal entries here. All right, so we're going to be recording these transactions here, okay, so that we can prepare a trial balance. All right, so we have the first transaction here. It says started a business with 205,000 kwacha in cash. So, colleagues, I will ask this question to you. What type of transaction is this? Because remember, identify the transaction, then you're going to see which accounts are involved. And after you see which accounts are involved, then you're going to see which one is increasing, which one's decreasing. And then, yes, Mr. Sunday. hmm And capital account, yes. But my question was, what type of transaction is this? Yeah, correct. Cash and capital account are involved. That is correct. Okay, this someone basically when I say what type of transaction is this, you just say this is someone starting a business. Okay, someone starting a business. So we have two accounts involved: the cash account and the capital account. So which one is increasing? Which one is decreasing? Or are they both decreasing or increasing? Someone to give it a try. Yes, Madam Yande, Mr. Sunday. Come again. Sorry, I never heard. Okay, you are breaking. Sorry, unfortunately, I can't hear. You are breaking. Okay, so the cash account is increasing and also the capital account is increasing. Remember, capital, these are the resources that are put into the business by the owner. That's one way to look at it. The second way, capital is what the business owes the owner. That's another way to look at it. So this cash that we're putting in is a resource, okay? Because capital can also include assets. When we say the resources put into the business, these resources can be cash, it can be cars, equipment. Yes. So capital is increasing, all right? And then also the cash account is also increasing because if at the beginning there was no money in the business. Now he's putting 205,000 kwacha cash. So the cash account is increasing. So we come to our double entry rules. Cash is an asset account. Increasing an asset, you debit. So going, oh, I don't know why I'm even spoon feeding colleagues. Okay, since I've already said for this one, the next one it will be I'll ask first before I type in. Okay. Remember, I want you to truly understand these things. So that's why I'm asking a lot, okay? So that you gain an understanding. Because if it's me just answering and me just talking, Yeah, you will say, okay, I've understood and everything, but when you face a question alone, you might get. So I want you to fully grasp. Okay, so don't be afraid when the questions come, even though it's wrong. At least if you get it wrong, that's how you even learn better. That's how when you get things wrong, that's where you even learn from. Okay, so we debit cash 205,000 kwacha. Increase in cash. Capital increases with credit. It's this C here. Okay, this is capital here. Okay, E is expenses, A is assets, D is drawings, L is liabilities, I is income, C is capital. So capital increases with credit. Yes. Any questions? Okay. We move to the next transaction. Put 90,000 of the cash into the bank account. So colleagues, what type of transaction is this? Oh, or if you don't know the transaction, you can tell me, okay, the accounts involved. Yes, Madam Agnes? Remember, since you are three, yes, Madam Yande? Okay, thank you for that. Thank you for that. Yes, yes, Mr. Sunday? That is correct, sir. Okay, that is correct. Bank account and cash account. Are we clear with that, Madam Yande, Madam Agnes? Are we okay with that? Cash, bank account. Cash, yes. Bank account and cash account. Yes. So, Mr. Sunday, which one is increasing? Which one's decreasing? Or Madam Yande, which one is increasing? Which one's decreasing? Because here the transaction is we're moving money from our cash account into the bank account. Okay, this is also called a contra entry also. Okay, where you're moving cash money from the cash account to the bank account or vice versa. That's correct. Uh-huh. What, what about cash account? The cash account is decreasing. Okay. So we go back to our diagram. Okay. Bank and cash are both assets. Okay. They are both assets. All right. So bank is increasing an asset, you debit. So we debit bank. Cash is an asset also. Now it's decreasing. So a decrease in an asset, you credit, okay? Because assets increase with debit, so it will mean if they are reducing them, they reduce with credit, okay, colleagues? So we debit bank and we credit cash. Okay, so Uh-huh. So we debit bank 90,000, increase in an asset. Then we credit cash, decrease in an asset 90,000. Okay. So any questions? Okay. Any questions? Yes, bank account is an asset. Yes, Madam Yande. Yes, it's an asset. Any questions, queries before we move to the next one, the next transaction? So the next transaction, bought goods for cash, 105,000, 100,500 kwacha. So, colleagues, what type of transaction is going on here? Bought, here you said bought goods for cash, 100,500. So what type of transaction is going on here? Good evening. Yes, yes, that's correct, sir. That is very correct. So, purchases and cash, right? So, which one is increasing? Which one is decreasing? Which one is increasing? Which one's decreasing? Yes. Let me just okay. Let me just correct you on that one. But thank you for your contribution. Yes. Whenever you incur an expense, think of it as so the expense has increased. Okay. If you incurred a new expense, so the expense increases. All right. And also remember all the time, whenever an expense is incurred, just remember just debit that expense. Okay. But according to the double entry rules, yes, expenses increase in an expense, you debit. Then cash is an asset. We are paying out that the cash. So it's a reduction in our asset. So we're going to credit it, right? So we debit purchases and we credit cash. 100,500 cash, 100,500. Yes. Any questions? All right. All right. So we go to the next transaction. Any questions before we go to the next transaction? Okay. Now here we've got multiple transactions with many people. Okay. But it says bought goods on credit from Dhaka, Hambe, Sombaile, and Lombe. Okay. So here we're going to look at the transactions with each person. Okay. Yes. So here we're buying goods on credit from somebody. That's the transaction. What accounts are going to be involved? We're buying goods on credit. Mhm. There's a liability involved. Yes. There's a liability involved. And what else? Mm-hmm. Yes. 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 Okay. So all of these people were buying from them on credit. Okay. So we're owing them. Liabilities, as we can see L here, liabilities increase with credit. So we're going to credit all those people. All right. Then purchases is an expense, so we debit the expense. Okay. So what we can do is we can put here purchases. Let's total up the amount. So we put here Hambe, Dhaka first. Dhaka, 8,000. Hambe, 93. Sombaile, 16,000. Lombe, 5,100. We're owing all these people. So what's the total so that I put you on purchases? When we total them up, what do we get? What's the total amount? 8,000 plus 93 plus 16,000 plus 5,100. What do we get as the total? Huh? 38,400. Yes. Any questions? Or the reason why I've put them like this, because there are other transactions that will involve them. But yes, you can when we reach control accounts, the purchases ledger control account where you get the totals of people owing you. That's what you do. But in this case here, the reason why I didn't do that because these same there'll be more transactions with them, and we're also going to need to make their individual accounts. Okay, so that's why I separated them like that. I could have also yes, and I could have also just done each. I would have done many journal entries, but to save time, okay, that's why I just did that. Yes. All right. Any questions so far? All right. Bought stationery on credit from Banda 890. Bought stationery on credit. Okay. Stationery, you can would say stationery expenses. Okay. And then since we bought on credit, there's a liability. So an expense and a liability here. Okay. So stationary expenses, expenses we debit 890. Liability here, Banda 890. Liabilities increase with credit. Okay. And I forgot to mention. So here we have witnessed the accruals concept here. All right. Whenever you incur an expense, even though you don't pay for it, record it. Okay, that's part of the accruals concept. And also remember the duality concept. Each transaction has got two accounts involved. Okay. So as we are doing these journal entries, I'll be reminding you of the concepts we looked at on our first class. Okay. So every time you see here, whenever we're making these credit purchases and we're incurring these purchases expense and we haven't paid for them, you're saying that we are recording them. That's the accruals concept there. All right. Sold goods on credit. M Sonda. Sold goods on credit to Aratonga, El Fashanu, M Sila, and M Sonda. So, what type of transaction is going on here? No, here there's no liability. Okay, because it's not we're not owing this time. Okay, so this time we're not owing. We're actually being owed. So it's the sales account and the receivables account. Oh no no no! I've removed the screen, madam. Don't worry. I'm going back to it. It sales and the receivables account. Receivables, that's money that's owed to you. Asset. Okay, You have sold goods to people, but they haven't paid you any money. They are owing you money. Again, here is also another part of the accruals concept. Even revenue, okay, when you make a credit sale, even though you do not receive the money, you're going to record it. This is also another part of the accruals concept, because it applies on expenses and revenue. Okay, so here we've made sales. Okay, we haven't been given cash, so we're still going to record it, and people are owing us. Okay, yes. So remember, receivables is an asset. Increase in an asset, you debit. Okay, receivables is the amount you're owed. The names of the people are debtors. Okay, these words are usually used interchangeably, but debtors refers to the names, then receivables is to the amount that you're owed. Okay, so debtors or receivables increase with a debit. Then sales revenue is a income account. Okay, income accounts or revenue accounts increase with credit. Okay, so we're going to credit sales and we'll debit. We're going to debit these people here, our debtors. So you start Aratonga 1,700. Elfashan 1,400. M Sila 3,260. M Sonda 2004. And then we credit sales. So 1,700 plus 24 plus 326 plus 2004. What do we get? Anyone with a calculator? I'm getting 9,364. Okay. Any questions? Yes. Any questions? Okay. Paid rent by check 2,200. What's going on here? Yes. I saw multiple hands raised. Yes, Madam Agnes. Mr. Sunday. I see your hands raised. Yes, yes. The two accounts involved, the rent expense account and the bank account. Rent X, we go to our double entry rules. Rent is an expense, an incur an expense, increase in an expense, debit. Bank is an asset. Okay. Now, since we're paying by check, so it means the money is reducing in the bank account. Reduction in an asset, you credit. Okay. Since an asset increases with the debit, so reduction, you credit. Okay. So we're going to debit. Just hold on, colleagues. Let me just respond to a message. So we debit rent and we credit bank. Okay, so we debit rent and we credit to bank. 2,200. Any questions? All right. The next transaction, bought fixtures on credit from Shefu Limited. So before I interject, what type of transaction is this, colleagues? Remember, give it a try. This is the part of the learning process. This is part of the learning process. Mm-hmm. Yes. Mm-hmm. Go ahead. Go ahead. Who was speaking? Mm-hmm. Yes, it's yes. You said yes. So that it's not an expense account. It's actually a non-current asset that's being bought. Okay, this is what we call capital expenditure. Okay, whenever you are purchasing these non-current assets, okay, that's what we call capital expenditure. That's a topic we're going to. Yes. So it's a non-current asset. These fixtures, this is a non-current asset. And then, yes, there is also a liability. So we go to the double entry rules. We bought an asset, increase in an asset, we debit the fixture. So we debit fixtures account, right? Then, since we haven't paid money, so we also have a liability. Increase in a liability, you credit. So credit chef. So it's a fixtures 6,100. Chef Limited 6,100. Any questions? Wonderful, wonderful. Okay. Ish, there are a lot of transactions coming on. Okay, the next one is paid salaries in cash 7,900. Okay. So even the wording of the sentence will give you an idea of what what type of transaction is going on here. Right. So here we're paying for salaries. So what types of accounts do we have here? Here we were paying in cash. Yes, and which other one? Salaries ex yes, yes, yes. Salary is an expense. Okay. So according to our double entry rules, increase in an expense, you debit. So salaries, debit 7,900. And cash is an asset. Reduction in an asset, you credit. Okay. So as I said, this diagram here, every time we are doing accounts, always have it. Okay. Always have this diagram here. Okay. Even in other topics. Okay. Once you know the rules of the account that you're dealing with, so if you know you're dealing with an asset account, you know that okay, anything to increase this asset account, it has to be debited. Anything to increase, if it's a liability account, anything to increase the liability, you credit. Right. All right. So now here we've got another transaction. Returned goods to Hambe 300 kwacha, Sombaile 420 kwacha. Yes, madam. Could you kindly repeat yourself? You are breaking on my end. Or if you can type out. If you can type out. No, no, I heard that. I think you're clear now. Where does the payable? Yes, when you don't pay money for so here now, returned goods to Hambe and Sombail. Remember earlier on, we bought goods from these people on credit. So we were owing them, right? These are these are our creditors. Okay. People we owe who we owe money, our creditors. Okay. Their liability. Now we bought goods from them and we find out some of the probably the goods could have been expired, destroyed, were the wrong goods. So we return some goods back to them. So two things happen here. Number one, what happens to the money that we're owing them when we return back some goods? What happens to the Congol, the money that we're owing them? Mhm. It decreases. Yes, it decreases. So that's a reduction. Oh, this is what we call return outwards or purchases returns. Okay, colleagues? When we reach the trading account, okay, when you see return outwards there on the trading account, this is what's happening here. We're returning goods back to our supply. So the money that we're owing them reduces. Reduction in the liability, you debit. Okay? Because liabilities increase with credit. So a reduction in the liability, you debit. Okay? Then purchases returns or return outwards is a contra expense account. Okay? Because it's reducing also our purchases expense. Remember when we bought these goods from these people, that was an expense on our part. Okay. Now, since we've sent the goods back, so even our purchases expense also needs to reduce. So a contra expense account, remember expenses increase with debit. So a contra expense, which reduces an expense, will be credited. So a credit return outwards because it's a contra expense. Then you debit your creditors because there's a reduction in how much they're owing you. Yes, Madam Agnes, you wanted to say something? Okay. So Hambe debit 300, reduction in liability debit. So Mbaile debit 420. Okay. Then return outwards, credit 720. Okay. Because according to the duality concept, both sides, debit and credit side, should be equal in every transaction. Okay. You should never have the debit not equal to the credit. Okay. The duality concept, as I said, both debit and credit also have to have equal amounts. Okay. Yes. So we'll just do our final one for today. This one here. Okay. Uh-huh. Excuse me. Yes, reduction in liabilities, debit. Yes, that's according to the double entry rules. Reduction in the liability, debit. Bought van by check 160,500. Uh-huh. Mm-hmm. Yes. Someone raised their hand. Is that a question or attempting to? Okay, go ahead, madam. Correct. Yeah. Bank account and van account. Yes, that's correct, madam. Thank you for that. Yeah. Then if we apply the double entry rules, what are we debiting and what are we crediting? What are we debiting and what are we crediting according to double entry? Yes. Yes. Van is an asset, increase in an asset, 160,500. You debit. Okay. Yes. Then bank is also an asset. Since money is coming out of the bank account and is reducing, reduction in an asset, you credit. So you credit bank 160,500.